Another issue that has been fascinating for me. It's been the trade-off for central banks between price level stability, bringing down inflation, and economic financial stability, especially regarding to what happened to the banking system and to the banks' balance sheets. Uh, were buying bonds, and after the interest rate rise, they've been hit quite hard. And what's your view on that, and how should the Fed balance those two policies?
Look, some banks have management that aren't that strong, that didn't do that well managing risk. And unfortunately, when you have tightening regimes, when the unemployment rate goes up, like we just said, there are some failures in business and there are some failures at banks, right? In the 1980s, you had, at the time, Fed Chairman Paul Volcker and FDIC Chairman Isaac. They understood that the cost of bringing down inflation was you're going to have some bank failures, and a lot of these banks were issuing mortgages and all kinds of long-term debt at 7%, 8%, and then rates went to 20%, 18%. So they just had to, unfortunately, restructure or have some problems, cut staff, recapitalize, and that is the role of banks, is to manage risk. And if you don't manage risk appropriately, then unfortunately you fail. As far as what the Fed is doing, the Fed already bailed out a lot of banks in March. They unleashed, during an inflationary battle, they unleashed $400 billion of liquidity into the market. Okay, England did the same thing late last year. Yeah, right. To save the banks and to promote financial stability, they unleashed liquidity into the market. What did that do? Asset prices went running. Financial conditions loosened. Bond spreads narrowed. Commodity prices increased, right? And when Powell was declaring victory in the February meeting, right? Now, oh, wow, inflation's a problem again. Because that's literally the conflict that you run into between financial stability and inflation. So he's trying to slow down, like when you're on the highway and you're 100 miles away from your destination, right? Let's say, you're going from Madrid to Berlin, right? So you're driving super fast, 100 miles an hour when you leave Madrid. But then once you start getting closer to Paris, right? And the city is in between Paris and Berlin, you start slowing down because you don't want to miss your exit because you're getting closer to your destination. So the Fed's getting closer to its terminal rate, so it's slowing down. 75 basis points, 75, now 50, now 25, now a pause, one or two more maybe, right? So that's kind of how I see Chairman Powell sort of accommodating those two risks. Not trying to blow up the financial system, but also trying to maintain discipline on inflation.
Great explanation. And do you think that the worst is beyond our back, or do you think that there's still may be some banks that are at risk, that didn't manage their risk so well, so that they are themselves at risk?
There's about 30 problem banks right now, and I think that you're going to have a few more. I don't think they're going to be large banks like SVB or First Republic or Signature, but you're going to have some smaller lenders have some problems. It's very difficult for them when a lot of the mortgages and debt that they issued 2 or 3 years ago at low rates, and now they have to pay so much to entice depositors, right? For example, Interactive Brokers were paying 4.58% on idle cash. Banks see that they have to compete now with Interactive Brokers, with all the other banks that are paying more. And you also have a bifurcation, right? Because those are the small banks that have to entice depositors. You know what the big banks are paying? Citi, JP Morgan Chase, those huge banks, they're paying close to zero, close to nothing. Why? Because they don't really want deposits. They have enough and they don't want more. So it's interesting bifurcation. Those regional players, smaller players that don't have a presence, that don't have an ATM machine every corner, they have to pay higher rates of interest, but their profitability isn't there, like the bigger banks. So it's a squeeze.